Hello, everybody. My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, please consider liking this video and subscribing to the channel so you see more. Today, we're going to be talking about the Kraft Heinz company, ticker KHC. As usual, I'm going to do a brief overview of the company. I'm going to take a look at the financials, the valuation, discuss the dividend, discuss the risks, and perform a brief technical analysis. Then ultimately, I will give it a grade, buy, sell, or hold. As always, this is not financial advice, and I am not a financial advisor, just a guy with opinions. So without further ado, let's jump into it. Kraft Heinz, Wikipedia page here. You know, in school, they said never use Wikipedia for research or reference. But I tell you what, that ended up being poor advice because I do that pretty much all the time when it comes to research. Anyways, Kraft Heinz was formed by the merger of Kraft Foods Group and the H.J. Heinz Company, 2015. Speaking of the 2015 merger, you may or may not be aware that that was orchestrated 2015 by Berkshire Hathaway in combination with this private equity firm 3G Capital. Essentially, what happened, as far as I'm aware, is that Berkshire Hathaway took the Heinz company, the H.J. Heinz company, private. One of the two companies was taken private by Berkshire Hathaway in 2013, and then 2 years later, they merged the two companies together into what is now KHC. In that time, the company has performed very poorly, down almost 70% in that 10-year time frame, and is essentially at an all-time low, essentially revisiting the all-time low level from COVID depths, kind of round trip all the way back. Very, very meager looking performance. So what's going on here? What is Kraft Heinz? Well, of course, many recognizable brands here. Kraft Heinz Company, together with its subsidiaries, manufactures and markets food and beverage products in North America and internationally. Under the Kraft, Oscar Mayer, Heinz, Philadelphia, Lunchables, Velveeta, Ore-Ida, Maxwell House, Kool-Aid, Jell-O, Heinz, ABC, Master, Hero, Kraft, Golden Circle, Waddy's, Pudlizgi, and Plasmon brands. A lot of names that I recognize, a lot of names that I don't. I'm sure my audience can relate, as all food brand companies tend to do. They've got that listed here on the website. So you get the idea. Right? We're talking processed, packaged food. Right? However, what's notable here is that this company has really struggled over the last 10 years to merge the two companies together. Clearly has been a failure in terms of creating shareholder value. Furthermore, the dividend we see here was cut in 2018 and has remained since that time. This report here, Warren Buffett and by virtue Berkshire Hathaway, as we mentioned previously, due to their involvement in the deal, they are actually the largest shareholder of the company, 27.5% of the shares. Reportedly, he's disappointed that the company has decided to go forward with the split and that shareholders don't get to vote on it. We are approached about selling our shares. We wouldn't accept the block bid unless the same offer is made to other Kraft Heinz holders. It certainly didn't turn out to be a brilliant idea to put them together, but I don't think taking them apart will fix it. I tend to agree with that. I don't really get the logic. I think consolidation often makes more sense than splitting up under the majority of circumstances due to the share of administrative expenses at the top. Given that all these food companies, they're not dissimilar from each other. Therefore, in that sense, I would imagine that there are synergies there, whereas you have certain companies that are largely conglomerate. Oftentimes, conglomerates maybe make sense to spin off businesses underneath that. Lots of good reports here in Seeking Alpha about what's going on. That last report, I believe it said that the shares dropped 5% on the news. I think that's an understandable reaction. So, is it a good deal? Um, well, first off, I don't really see the money to be made here off the top of my head in purchasing the shares, just right off the bat, purchasing the shares prior to the split. I don't really see how, again, not really knowing much about the numbers, which we'll look at. I don't really see how splitting up the companies creates value unless the two different segments, the two different companies, have significantly different finances. In which case, I would assume that they don't. However, maybe we'll see that in their financials. I'm not sure. The current valuation of the shares is certainly very attractive. Less than 10 times earnings, more than 6% yield on the dividend. I mean, that's certainly very attractive, right? So let's just take a look at their numbers. Revenues, 18.3 billion January 2016 to 25.3 billion. However, we've been largely flat on the revenue side since 2019. Of course, I remember that's also the year that they coincidentally cut the dividend. In fact, they've effectively been flat the entire time. Remember, this 2015, 2016, that was the year of our merger. It does appear that revenues have not grown at all over the time period. Yeah, we should be looking at this number, not this number. Revenues have not grown since the merger. Gross profits have not grown. Both have modestly declined. I'm not going to do the math, but I believe that the gross profit margin in this year is higher than this year. So it does not look good. And our operating income has declined. It appears, again, not going to do the math, but just taking a look at the slope of the chart, it appears that our operating income has contracted more sharply than gross profit. So that doesn't look very good. Very lumpy earnings. Continued operations graph, we see that the EBT, including unusual items, well, it appears that there were some unusual items in a few of those periods. So no discernible pattern. Excluding extra items, looks roughly the same. So they just had a bad year in 2018. Revenue per share effectively has been flat over that time frame. Their amount of shares has stayed relatively the same. I mean, in the last 12 months, their most recent report here, their average shares is lower. But again, that's effectively flat. So, just want to make a comment here. This is a business that is very profitable. I mean, again, what's 8.7 divided by 25? That's, about a third, a little bit more. That's mid 30% gross margin. It's not exceptional, particularly for consumer brands. Not exceptional margins by any means, but the company is definitely profitable, and it certainly is not struggling to pay bills. Furthermore, the fact that they have not increased the dividend, I find to be a positive. I find that to be appropriate. There's no growth. There's no growth for them to raise into. So it's good that they've been paying out. It's good that they've been just kind of floating the ship. It makes all the sense in the world that the share price has been largely contained within the range that it's been the last few weeks. Okay, they cut here. That's coincidentally the period where they just, you see here, Earnings per share hasn't really gone anywhere. It's been hovering in the twos pretty much the whole time, with the exception of this year. Just very, very underwhelming looking numbers. They don't look bad. They don't look good. They're not concerning looking. They're not good looking. They're just very mid looking numbers. If we take a look at the balance sheet, cash and equivalents, um, they're certainly at the currently at the low end of the range. 1.6 billion of cash, um, which is one of the bottom 5 years in the last 10. 2.3 of AR here. 3.6 billion of inventory. So 9.9 and a quarter of current assets. Got plenty of property. $12.5 billion property. Look at this. Lots of goodwill, which is effectively an intangible asset. Other intangibles. That's pretty crazy, right? They're basically saying $38 billion of intangible assets. In other words, they're brands. I'm not an accountant, but to me, those aren't really worth a whole lot in terms of what I care about, which is the blood budget. How much cash do we need versus what we owe? These are certainly not worth nothing, but something to keep in mind when you're looking at this balance sheet. They're saying, yeah, we got $81.5 billion of assets. Oh, by the way, 60 billion of that is completely intangible. Nope, I think I'd rather look at the 9.25 of current assets and 7.25 property. Current liabilities of 8.6, of which 4.3 is AP and 1.9 is current portion of debt. 8.6 versus their 9.25 of current assets. So, yeah, they have enough cash to pay their bills. Of course, liabilities. The dividend is not counted as a liability on the balance sheet. They're not exactly flush with all this excess, extra cash laying around. Long-term debt, they have deleveraged somewhat over that time frame, which is encouraging. They've been paying that down. So that looks good. We've decreased our liabilities by 14 billion over that time frame, give or take. Retained earnings have, that trend is largely up, with the exception of this year. Here, retained earnings, of course, are cumulative. So, if they're negative in a given year, that could imply that there was a lot of stuff jammed into the balance sheet of the two consolidated companies that wasn't so good. So it might be worth it to drill down more into the quarterly numbers. You might notice that if you read my articles, I focus on retained earnings quite a bit, just to give an idea of the momentum of a business. We see here retained earnings modestly drifting upwards. Retained earnings, in my view, being decreasing, already negative and decreasing fast, or positive and decreasing over each quarter in a well-defined trend, indicate that the company is paying out more to shareholders, or to creditors than it makes. And while that's not necessarily indicative of a problem, it certainly isn't encouraging. So retained earnings looks okay. Ultimately, I think that the way that this business is managed from a financial perspective looks appropriate, given the way that their balance sheet and their income statement looks. However, just very, very, very underwhelming looking financials. Cash per share. Remember, we had how much cash? We had 1.5 billion cash on hand. I believe that our dividend is bigger than the current amount of cash that they have. So it gives you an idea of just how much cash it's generating. be able to service that dividend. It looks relatively safe. Total debt, $21 billion. So they have nowhere near enough cash to pay off all that debt. Again, that's probably fine. They're generating plenty of cash. So I want to circle back to this. If you take a look at these brands, we've got, you know, I like to eat whole, healthy foods for the most part. I don't really like to, I don't avoid eating processed foods, but I don't go out of my way to eat them as a matter of principle. And I think there is something to be said about the fact that the brands here are not really in favor with consumers for a forward-looking thing. Now, of course, there are some very valuable brands that I think have a lot of staying power, particularly the Philadelphia. That's the cream cheese. Um, Great. This is like me speaking for my preference as like a health-oriented consumer. You know, I see no issue picking up this cream cheese. I see no issue picking up this mustard from a health perspective. Whereas, you know, I'm probably not going to drink Kool-Aid. I'll have this Classico stuff. I'm not going to drink Kool-Aid, right? Velveeta, you know, not really my thing. So that's one thing I've noticed about a lot of these food companies is, you know, they're this company is it just feels very vintage in terms of the brands. Like these were great brands in the 80s or something. You know, I'm being very critical. Um, how does that translate for through numbers? I think you get an idea looking at their numbers. That these brands, they have plenty of sales. However, the fact that gross profits are declining somewhat. Maybe we should look at the gross margins. Gross margins. The fact that our gross margins are declining seemingly over the 10-year time frame. They are lower today than 10 years ago, however, not necessarily just a decline, just inconsistency in margins. I think the fact that you see inconsistent and modestly declining gross margins, that tells you everything you need to know about the staying power of some of the processed food brands that they have. And then we've got this whole other narrative of the GLP-1 drugs that are shaping kind of negative sentiment around around these things. So I can totally understand why the market wouldn't like this stock. There's nothing sexy about it. There's nothing um, future oriented about the store. The brands are largely uninspiring. I'm being very critical. The brands are largely uninspiring, and um, there's just not a lot to get excited about. Like any other food stocks that I can really think of, I'm going to decline to include Hershey in that because Hershey is more of a I'm also going to include Flowers food. Hershey's been the best performer, but very uninspired performance. I will say Kraft Heinz has been the worst performing one, followed by Flowers. This is over 10 years, by the way. So, again, I'm kind of drifting off, but Hershey's products, I think that they benefit from not needing to be so health oriented. It's candy after all. Are we really wanting to be health oriented when we're eating candy? Whereas these brands here, I think that this company is a perfect example of a story that's very out of favor between consumer trends and the GLP-1 sentiment. And the numbers certainly don't help. The company doesn't continue to grow in the face of that. In fact, they've been very stagnant far before there was such a thing as Ozempic. And now we're in the very early stages of seeing how something like that might impact a company like this. And then this breakup thing also, I think what we need to do is we need to briefly discuss here in a second what the two companies are going to do, but we'll get into that in a moment. First, let's take a look at the valuation. Very, very attractively valued, both on a relative basis. It's cheaper now than it has been over the 5-year average in pretty much every one of these categories. I mean, even the dividend yield over the last 5 years has been 4.6. We're over 6.25% now. Our price book is below the 5-year average, still less than 1 on the 5-year average. Price sales far below. We see here between 15 and 40% lower on every single valuation metric. Seeking Alpha has the valuation as an A. I agree. It looks exceptionally cheap. To augment that reality, our dividend yield is not the highest that it's been over the last 10 years, but during these periods here, it's right before, I believe, a dividend cut. Dividend cut was our last tall dividend, November 14th, 2018. So the first quarter of 2019 is when we started getting down there. So the dividend was cut, and then it appears the stock declined sharply here. So in terms of the current payout, we are at the highest yield over the last 10 years. Very attractive. I certainly don't think, based on what I'm looking at in the numbers, that the dividend is at risk of being cut. The dividend looks relatively safe, I would say. Seeking Alpha, I don't know what they say about safety. Our payout ratio is, 40 to 60%, depending on which metric you use. They do have a lot of debt, but the company looks profitable, looks highly profitable. I don't think that they have an issue with cash generation. And I am encouraged by the fact that they're not raising the dividend. I think that that's very appropriate. Of course, I would love to raise the dividend, but I want the underlying business to have the growth to support it. And it's just not there. So what are the risks? I think the risks are clear. You see the brands. Again, many of my viewers may disagree. There may be brands here that they love. There's certainly brands that I like within this. But I think the main issue here is just where's the growth going to come from? Are they going to start acquiring more health-oriented brands? We see how other food companies in the space have been attempting to do that, notably Flowers. I need to circle back to Flowers, but Flowers, they raised $800 million of debt financing to go buy Simple Mills, and their stock seems to continue to go down on a daily basis because the numbers are questionable on that type of deal. So are they just going to start trying to buy healthier options? So far, we haven't really seen that pay off. Philip Morris, of course, the tobacco company, they suffered from this same issue until they found a way to make money on smoke-free products, right? And now they're seeing a resurgence. What's the smoke-free product of food stocks? I don't think that we've seen that yet, especially within the face of the GLP-1s. So what's the risk? I think you just have very flat financials. There's no clear catalyst, but a lot of the downside has already been baked in. So honestly, I don't see that there really being a ton of downside risk at the current valuation. I think the current valuation is very attractive. I don't think that there's a lot of downside risk. I just don't really see how there's a lot of upside risk either. What's the catalyst? Them trying to split up the companies that they merged, I agree with Warren Buffett. I don't really see how that creates value. I'll tell you what doesn't create value, these names. Tentatively named Global Taste Elevation Company and North American Grocery Company. How boring, right? Everything about this is boring. Sorry if you work at Kraft Heinz or are a Kraft Heinz evangelist. No disrespect to you. I mean it in the most endearing way possible. Sometimes boring can be very good. But in this context, this company is very middling in many respects. So, Warren Buffett, basically, vaguely or not, implied that he's very disappointed, not just with the split, but with the performance. They wrote down their investment. They wrote down their investment by $3.5–4 billion, something like that. Quite a bit, right? So, yeah, I think that if you're looking for a deal, at a good yield, and you're not, expecting a ton of dividend growth in the interim, I think that this one presents compelling value, but it's really hard for me to get excited about because the management team wanting to split up here seems very uninspired. It seems it seems like let's rely more on financial engineering to possibly create shareholder value than messing with our brands or investing in better brands or newer brands or whatever. So let's just take a look at the chart. We kind of have this longer term deal here, and then we broke out below. It's kind of like just kind of a very clean and uninterrupted sequence of, we fell all the way down. We were doing good. We just tumbled when they start cutting the dividend. Again, it's like the investment here riding high on right from here up. We're riding high on the fact that Warren Buffett has his skin in the game. Dangerous thing to get and to fall in love with and be enchanted by the way. And then we just tumble. Well, really before that, we kind of found a base. The COVID low hit, we recovered above that. And then we've been just inching our way along. And all furthermore, okay, we bounced 3 times off of this level here. And we broke down out of that uptrend. We kind of hit this line right here. We broke out of our uptrend all the way down here. And then we have been in the downtrend. See that? We kind of fiddled with this area. So we broke out of that before. We were trending up, not tightly. We broke out. Now we're trending down. Where we're at now, I guess this isn't a candlestick chart here, but in terms of this charting, which I think might be the ending price on a day, according to this chart, we're essentially at all-time lows here. On this chart, you see how we went far below that. I get confused here at what's different. But the idea remains that the current level that we have, the price descends. We failed here. We failed 4 times to break above, and we bounced off of trend line support down 1, 2, 3, 4 times. The current price level is right in the middle of that channel. So again, I think if you're comfortable with the fact that there's no evidence that we are breaking out of this anytime soon, there's no clear catalyst. The market didn't like the split news. Warren Buffett is throwing his hat in the air and saying, "Yeah, I don't like what's going on." If you're comfortable with all that and think that we're going to turn this around, I don't see any reason to not add here because we're just in throes of a downtrend. But perhaps expect that there might be more downside. The current value is decent. Valuation is continuous, right in the middle. See, we gap down on the news, down again today. Lots of volatility in the shares. We've plugged into a clean downtrend. A lot to be cautious of. So ultimately, my grade here is avoid. Frankly, because I see nothing to be inspired by. So for me, it's an avoid. Mainly because I don't really see the appeal over the long term. I'm uninspired by the brands. I'm uninspired by the financial performance. I'm uninspired by what appears to really be a lack of clear strategy. Therefore, for me, it is an avoid. However, I think that it does have redeemable value at the current valuation. And I think if your whole strategy centers around you just want to collect a yield that is several hundred basis points above the 10-year treasury yield, and you want equity-like volatility, then this certainly fits the pocket, and there might be some modest upside. Again, we're trading basically at all-time lows. But I don't necessarily think it'll just bounce back because of that. anything, the outlook now is more poor than it was back in 2019. So for me, for that reason, it earns an avoid. Even though the main downside risks I see from here, at least in the immediate term, are very technical. Looking at that chart, we're just trending down. Maybe there's some modest volatility to the downside. I think over the long term, there's more than enough cash generation for them to invest in the right strategy. We just don't really see any clear indication that they'll do that. So something to keep in mind. So that will conclude the video for today. Hopefully you found this interesting and instructive. And let me know how I'm doing. Comment below with your thoughts, any suggestions on tickers you'd like me to cover. Let me know what you think about this stock. Certainly an interesting one, but very uninspiring in my opinion. Um, and that matters, I think, because sentiment drives prices in a lot of ways. And oftentimes it drives prices before financials catch up. So just something to keep in mind. Anyways, hopefully you found this entertaining, useful, and instructive. And thank you for watching. I appreciate that. If you found this interesting, consider liking and subscribing so you see more of it. And in the meantime, I will get back to writing my dedicated write-up on this to put to Seeking Alpha, where I dive a little bit more into the details. So be sure to follow me on there and check out this article. All right, thank you for watching and have a good rest of your day, and I'll talk to you soon. Goodbye.